Happy Friday, everybody. Another heck of a week, no? Today is July 15th, 2022, and this is your Friday planning video. Today I want to review a few items that should be on our planning list for the second half of the year. Then we're going to talk about some education planning. Before I get into that too far, as you hear me say every time I bring up anything with your taxes, I do not give personal tax advice, and the ideas that I'm talking about are not for everyone. We should discuss them with your personal tax plan in mind, and we'll talk to your tax advisor to figure out if it works for you. Now the review. Roth IRAs, two things with them to remember. First of all, as we've discussed, it may be a good time to consider a Roth conversion. It's important to know your current and potentially your future tax situations, or at least what you think that may be, but the math may work for you to convert some of your tax-deferred traditional IRA money into a Roth IRA with future tax-free withdrawals. Recall that there is a tax event to make that happen, but let's talk about it and determine with your position if it makes sense. Also about Roths, recall that we have been watching Congress about the possible removal of the backdoor Roth IRA and the Build Back Better legislation. As of now, it's still there, it's still available. Recall this is another way to get money into that same Roth IRA I just mentioned with future tax-free withdrawals. Under normal circumstances, if you've adjusted gross income above certain levels, you can no longer make a contribution to that Roth IRA. You can, though, make a non-deductible contribution to your traditional IRA, then convert that to a Roth. Again, this might be right for you and your situation, might not, so let's talk about it. One last item in the review list. I don't have to remind you that the market is down for the year, about 20% on the S&P 500. Many stocks are down even more than that. It may be a worthwhile exercise in your taxable accounts to review for any possible capital losses that make sense to realize. Remember, this is taking a stock that you paid $10,000 for and is currently worth $5,000 and selling it. So recognize the loss for this tax year. If you have capital gains in your holdings this year already, or if you recognize some later in the year, these realized losses may be useful to offset those gains. Simply put, let's review if you have losses that may make sense to take. We always say that you really don't lose any money until you sell, so let's talk about if it makes sense. It may be a way to find a silver lining in this lower market. Okay, on to a few other items. Today I want to start the first of a multi-part series on education savings. I'll be adding to this email the link to the coffee chat from a few years ago where we reviewed the uses for 529 accounts. It's about a 15-minute webinar. Feel free to take a look at that. I'll give you 6 ways that you can use to save for college, and I'll give you a few pros and a few cons for each. In coming weeks, we'll talk more about this, like what you cannot pay for with 529 college plans. Also, I'll get into a little bit about how certain plans affect financial aid. So first, let's go with the list of ways to save for education. In this case, specifically college, but for a few of these, it may work for other education needs. The easy one, mutual funds. These, as you know, are multi-purpose. You can use them for almost anything. The pros, there's no limit on how much you can invest, and also there's no restriction on how you can use the money. The cons, the earnings can be subject to annual income taxes, and there are capital gains due when you sell them. Hold on, you'll see how that differs. Next, custodial accounts. These are usually called UTMA or UGMA accounts. That's Uniform Gift to Minors Act or Uniform Transfer to Minors Act. I'll go over these in another video. But pros, you can also spend that money on anything. Very little restrictions as long as the money is used to benefit the minor. Also, no limit on how much you can invest. And finally, the value of the account is removed from the donor's estate. The cons, earnings and gains are subject to special taxation. The kiddie tax applies, but that is beyond the scope of today, so consult your tax advisor for details on that. Also, the student will gain full rights to this account once they reach the age of majority. Their use case may be different than what the donor or parent had in mind. It is not restricted. That's a big con to remember. Okay, here's another one. Seldom used, but with rates moving up, something you may think more of. Qualified U.S. savings bonds. So the pros, federally tax deferred and state tax free. Also, if EE bonds or I bonds were purchased after 1989, they may be redeemed federally tax free if they're used for qualified education expenses. We'll talk about exactly what that is and what is not in a qualified expense in another video. Finally, the bonds are backed by the full faith and credit of the U.S. government. Pretty safe on a scale of risk, no? So the cons, maximum investment allowed per person is $10,000 per year per type of bond. $20,000 for a married couple. There's also a different tax treatment of the interest based on your adjusted gross income. This leads to the interest from the bonds being subject to taxation if you do not spend the money on tuition and fees. So now, the next one, back to the Roth IRA. I bet you didn't think that this one was going to hit this list, but it does. Recall that there are complex rules on who can contribute to these, so let's confirm that. I will tell you that the rules on using this for college planning is actually pretty complex. And to keep it from getting too much into this, let's just say if you want to examine this option, please consult your tax advisor or myself for all the rules. Sorry about that, but a few pros that we can add: investment options are vast, and the assets are not counted on the FAFSA form for financial aid. The cons: maximum investment per year is $6,000 per person, $7,000 if you're over 50. Also, contribution limits, as we spoke about, based on your adjusted gross income. And finally, withdrawals are considered a base year income on the FAFSA form. So two more: Coverdell IRA. This was originally called the Education IRA before 2002. Very rarely used, mostly because of all the other options. Also, since the maximum investment is still $2,000 per year. I can't tell you the last time that this came up as the best option, so we'll leave that alone. Finally, the headliner in college savings, and now even K through 12 in many states, not Illinois, but 529 college savings plans. This allows the investments to grow, and the earnings and withdrawals are completely tax-free when used for qualified education expenses. In addition to that, as if you needed more, pros: depending on the plan, the maximum amount in the plan can be over $500,000 for the life of the plan. $16,000 per year per person, and it qualifies as the gift tax exclusion. Also, there's a way to front load 5 years worth of gifts into the year one. Lots of good reasons to do this, but the major one is to shelter that growth from taxes for longer. Also, for financial aid, the plan does get favorable treatment. If they're owned by a dependent student, it is treated as a parental asset and does not have to be reported on the FAFSA form when funds are withdrawn for qualified expenses. A few cons: if you don't use the money for qualified expenses, there's a 10% penalty, as well as the money is taxed when it comes out. The investment choices are often pretty limited, and if someone other than a student or parent withdraws that money, think grandparent here, the money is treated as income for the student and can reduce financial aid, sometimes by as much as 50% or more. One of the pros, and actually one of my favorites: don't worry if your child gets a scholarship or chooses to go to the school a school that the money's not all used. This account can be transferred to other family members or even to the next generation without being counted in the donor's estate. This is more complex, but know that there was an estate planning use thought about when these first came about. Okay, that's what I have for you today. We'll do more in the coming weeks about education savings. As many of the kiddos are home for the summer, it's a good time to focus on paying for their education. As always, it'll be the plan that gives you the best chance for success. So this is with education planning, and of course all the planning we do. We establish the goals, we plan how to meet them, we execute that plan, we evaluate the plan, and we make changes when they're needed. That's the recipe for success, or at least the recipe for a good chance at success. So let's stay in touch on these and other planning topics. Have a great weekend, and we'll see you Monday for the Monday Market Update.